next 24 hours, finance ministers from 3 East African countries will present their tax and spending plans for 2019-2020 fiscal year. For Kenya, Uganda and Tanzania, their budgets are expected to focus on widening their national tax bases, even as their debt service obligations rise. The cost of servicing rapidly acquired debt is taking up an increasing percentage of each country's available tax revenues. Kenya spends 30% of its tax revenues servicing over $54 billion in outstanding public debt. Uganda and Tanzania are in worse shape, with between $4 and $5 out of every 10 they raise in taxes going into debt service. In the next fiscal year, the IMF forecast that interest costs will take up 20% of Uganda's tax revenues. Last year, Kenya proposed imposing a new tax rate of 35% on corporate and personal income tax. It also proposed a so-called Robin Hood tax on bank transactions over $5,000 in order to fund universal health coverage, as well as an additional levy on employers and employees to fund construction of affordable housing. The first 2 ideas were shot down by legislators. The third has been frozen by Kenya's courts. All right, so let's go through all of these. What should we expect in the budget for 2019-2020 fiscal year as far as taxes are concerned? Sandeep Main is a senior manager in charge of tax matters at KPMG's Kenyan arm. He's with me right here in studio. Thank you very much for joining us. So let's break it all down, all of that tax talk. Kenya's revenue, of course, a huge debate, spending rising year on year, and the tax revenue is not keeping up with that demand for spending. What realistic measures for fiscal consolidation can be put in place?
Thanks for that question. I think to answer that, I'm going to break it up into expenditure and revenue. And to understand that, Kenya's total budget is actually 80% of it is allocated towards expenditure. So if 80% is allocated towards expenditure, that only leaves about 20% to actually development of the infrastructure projects. So obviously, I believe that the government actually needs to relook or review the expenditure, the recurrent expenditure, which is basically the wage bill, and see how that can be reduced in order to give a higher amount towards the development projects. And that can only be done, obviously, in the medium to long term. I don't think it's something that can be done in the short term. Yeah.
All right, so the state allocated 314 billion Kenya shillings. That's around about $3 billion to counties. Did this money make a difference?
Absolutely it did, but we do have some issues that perhaps you can discuss. One of them being that the revenue that was allocated to the counties, or the budget for expenditure, was actually based on 2016 audited accounts, which is 2 years ago. So ideally, if the audited accounts up to 2018 were done, and the allocation would have been far higher for the expenditure. And again, linking it back to my initial comments, if the government can actually review its recurrent expenditure, then we'll have a far higher allocation for development projects.
Okay,
yeah.
So then we have the several proposed taxes we mentioned there last year. The Robin Hood tax that was of course was shut down. We had the proposed 30% rebate for manufacturers. It was approved, but so far no implementation on that one. So should we expect some of these ideas to be carried forward into this financial year, given the lag in implementation?
That's a very interesting question, and personally, I think those were highly contentious proposals, hence the shot down. But I do think that the minister might, so I don't think those will come back, but I do believe that the minister might come up with other measures, such as perhaps expanding the VAT base by reducing the exempt and goods and services. Also, he might go the excess duty way, whereby excess duty is increased on an inflationary basis, which means every year excess duty increases. So that could happen for consumption taxes.
Okay, and then we have the tax amnesty program that was extended to run until 30th of June last year. This year from last year, that was the initial target. So what difference has this made to the tax base?
Well, no difference to the tax base, no difference to the tax revenues. Remember, amnesty is something that, amnesty itself means that no questions asked. So basically, it did not have a difference on the tax revenue or the tax base, but it did help stabilize the forex rates for the country. Okay. So no difference.
All right.
Yeah.
So then we talked about this 35% proposed tax rate for corporate and personal income, and that was, of course, not implemented. It was dropped. But we're seeing spending demands more and more in the 2019-2020 financial year. That's at over 3 trillion shillings, which is about $29.6 billion US. Do you expect this proposal to return?
Personally, I don't think they should return. So I'm going to break that question up into two. Let's deal with the corporate income tax angle first. So from a CIT, corporate income tax angle, if Kenya does go by increasing the corporate income tax rate, then it would be doing the exact opposite of what's happening globally.
Right.
Globally, countries are trying to reduce their CIT rates so that they can attract investors. But if Kenya goes that way, then it will become a very unattractive market, number one. Number two, we must also appreciate we operate in an East African community, and then there's the Africa free trade zones that are coming up. So an investor from Europe or wherever looking into Africa will actually see where best can I place my business or my hub to operate within Africa. And then obviously that has ripple impact onto existing businesses that have hubs here, multinationals. If Kenya does increase the rate, then it's highly likely that they might want to move their hub to other countries within the region or within the continent.
Right.
So that's from a corporate income tax perspective. If you look at it from an employee tax perspective, I mean, I would much rather that the minister actually widen the tax bracket, which then effectively means that you and I as individuals will have a higher net income for spending purposes. So perhaps the focus should not be on increasing the employee taxes, but perhaps look at increasing consumption taxes. The more money you have, the more you'll spend.
Okay.
That's logic.
So the big day is, of course, tomorrow. We shall wait and see how that pans out. Exactly.
Yep,
Thank you very much for joining us. We have to leave it there. Sandeep Main from KPMG Kenya here in studio with us.